All right, Lauren, thank you very much. Let's take a look at these markets for you. It's all very muted this morning. You can see across the board we are down, but we're just treading water, waiting for the Fed minutes later on this afternoon. David Stryzewski joins me now. David, great to see you. We know that tech has led the market rally, but is there anywhere else that we can look to put our money right now?
Hey, good morning. Great to be with you, Ashley. So the goal to investing is to ride bulls and to tame bears. You know, we're looking for 70 to 80% of the gain while missing 70 to 80% of the gain, pain rather. So the point is that, you know, we've had this TINA economy where there is no alternative has been this concept that's been out there other than tech. So I would say today that we've got a Terra economy. There are reasonable alternatives. So as an example right now, we're getting paid 5% on short-term treasuries, you know, so we're getting paid on cash. That's a new reality here for over the last 15 years. On protected assets, though, this is where I believe that many are missing it today and could be setting themselves up with too much risk right now as they put too much hope in corporate bonds. And so one alternative idea to corporate bonds right now would be looking at things like growth-oriented fixed indexed annuities. These are insurance contracts that are literally so popular right now. They're having their record year. They tend to perform very well in cycles that are you know, very volatile, like we're seeing right now, and they also provide some liquidity. So that's a concept to be looking at. We've got 30 different portfolios, so I'm going to say however you want to manage money or you believe that your theory or theme is going to work out in the market, you know, as long as you stick with a strategy, it's going to work out over time. I do think today, though, that we need to be more active as opposed to passive. I think that we need to be more individual in names right now and rifled in our approach as opposed to just buying broad-based markets because it seems like, you know, relative to their peers, we're going to have names that are going to perform better than others.
All right, David, before we run out of time here, I want to get into the Fed. You say they're likely done hiking, but we've had many analysts say, look, you know, Jay Powell is hell-bent on essentially crashing the economy to get to his 2% inflation level. What do you say to that?
I'd say Powell has a really hard job right now. You know, he can do right, he can't do wrong. I mean, he's actually more of a dovish character in general if we just look back at who he is and how he's acted in the past. I believe that he's done hiking. And the reason why I say that is because, you know, banks are going to have a very difficult time competing at this interest rate level. And if banks can't keep cash on hand in order to make loans, which for them, those are assets. For us, those are liabilities. That's going to be a really big problem right now. But I think Q3, Q4, we've got some pretty significant stuff heading down the pike here. He doesn't want to get the market ahead of itself and, you know, just rallying up to higher highs. That's inflationary. But I think he also recognizes that, you know, we could be seeing, you know, a lag effect here as he's raised these rates. We've got to get them priced in. But also, I think we could actually be seeing higher inflation here in the future. So if they're unwilling to get off this, you know, 2% number, then, yeah, he's going to have to raise them. He's going to have to do something radical.
That's exactly right. I don't think they are, to be honest with you, David, but we'll see. David, thank you so much for talking with us today. We do appreciate it. Market, as we know, moving